The origins of banking in England emerge not from grand institutional design, but from the practical necessities of medieval commerce and the gradual accumulation of financial practices that would eventually coalesce into recognizable banking structures. So, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. And let me know in the comments where you're tuning in from and what time it is for you. It's always fascinating to see who's joining us from around the world. Phone face down, volume at a whisper. Let's dive in. The medieval English economy of the 11th and 12th centuries operated primarily through barter and limited coinage, with the Norman conquest of 1066 introducing continental financial practices that would gradually transform the island's monetary landscape. The Domesday Book, compiled in 1086, revealed an economy still heavily dependent on agricultural production and feudal obligations, where monetary transactions remained secondary to relationships of land tenure and personal service. The limited supply of precious metals and the absence of sophisticated credit mechanisms meant that most economic activity occurred through direct exchange or obligations recorded in manorial courts, rather than through financial plan intermediation. The Jewish communities that had arrived with William the Conqueror provided the earliest recognizable banking services in medieval England, filling a crucial economic niche that Christian doctrine complicated through prohibitions on usury that made lending money at interest problematic for adherents of the dominant faith. These Jewish financiers operated under royal protection that proved both valuable and precarious, as their legal status depended entirely on monarchical favor that could be withdrawn at any moment for fiscal or political convenience. The period between 1066 and 1290 saw Jewish moneylenders become essential components of England's financial infrastructure, providing credit to nobles, merchants, and even religious houses that required capital for various undertakings ranging from military expeditions to commercial ventures to ecclesiastical construction projects. The mechanics of medieval Jewish banking in England involved careful documentation of loans through written bonds and the use of physical security in the form of pledged property or goods that could be seized upon default, creating a system of collateralized lending that would influence subsequent banking practices. The Arca system, established during the reign of Henry II, required that copies of all Jewish financial transactions be deposited in locked chests, maintained in specific towns throughout the kingdom, providing both a record of obligations and a mechanism through which the Crown could monitor and ultimately exploit this lucrative lending activity. The royal government extracted substantial revenues from Jewish financiers through a combination of direct taxation, forced loans, and the appropriation of assets from deceased lenders whose estates reverted to the Crown rather than passing through normal inheritance patterns. This predatory relationship between the monarchy and Jewish banking communities created an unsustainable dynamic that would ultimately lead to the complete expulsion of Jews from England in 1290 under Edward I, eliminating the kingdom's most sophisticated financial intermediaries and creating a vacuum that would take generations to fill adequately. The immediate aftermath of the expulsion saw Italian banking houses, particularly those from Lombardy and Tuscany, expand their operations in England to provide the credit services that had previously been dominated by Jewish lenders, bringing with them more advanced accounting techniques and stronger international connections that reflected their Mediterranean commercial origins. The Lombard bankers, who established operations in London during the late 13th and early 14th centuries, introduced double-entry bookkeeping and sophisticated bills of exchange that facilitated long-distance trade, without the dangerous and cumbersome transportation of actual coinage across bandit-infested routes. The street in London that would eventually bear the name Lombard Street emerged as the center of this Italian banking presence, with merchant bankers from Florence, Lucca, and Siena establishing offices that served both commercial clients and the English crown in its perpetual need for ready money to finance military campaigns and administrative expenses. The relationship between Italian banking houses and English monarchs followed patterns similar to those that had characterized Jewish lending, with royal borrowing creating dependencies that monarchs frequently exploited through defaults, forced renegotiations, or the arbitrary seizure of assets, when immediate fiscal pressures outweighed concerns about future creditworthiness. The famous bankruptcies of the Bardi and Peruzzi banking houses in the 1340s resulted partly from Edward III's default on massive loans contracted to finance the early stages of the Hundred Years' War, demonstrating how sovereign borrowing could destroy even the most powerful financial institutions when kings prioritized military ambitions over fiscal responsibility. The development of English commercial law during the medieval period gradually created a more stable framework for financial transactions through the evolution of common law principles that governed contracts, property rights, and the enforcement of debts. The growth of merchant courts and the development of the law merchant provided specialized forums and legal doctrines that addressed the specific needs of commercial parties in ways that traditional manorial and royal courts could not adequately serve, creating a parallel legal system that would eventually merge with common law to form a comprehensive commercial jurisprudence. The introduction of bills of exchange and other negotiable instruments during the 14th and 15th centuries represented crucial innovations that enabled the development of more sophisticated credit networks by allowing claims to be transferred between parties without the cumbersome procedures that characterize traditional debt assignments. These financial instruments created a form of paper credit that could circulate as a medium of exchange, while the actual settlement of accounts could be deferred and consolidated through periodic clearing operations at major trading fairs or financial centers. The English wool trade with Flanders and Italy during the 14th and 15th centuries generated the sustained commercial activity and capital accumulation that provided foundations for more elaborate banking operations, as merchants dealing in this valuable commodity required credit to purchase wool from producers, finance its transportation to manufacturing centers, and await payment from continental buyers. The Merchants of the Staple, a regulated company that held monopoly rights over wool exports through designated staple towns, developed sophisticated financial practices that included providing credit to wool producers and accepting wool as collateral for loans, creating an early form of commodity-backed lending that would influence later banking development. The royal government's practice of borrowing against anticipated customs revenues collected on wool exports created another form of credit instrument that linked commercial activity, taxation, and royal finance in ways that foreshadowed later developments in public debt and government borrowing. The 15th century saw the gradual emergence of English merchants and financiers capable of providing banking services previously dominated by foreign lenders, reflecting both the maturation of English commercial practices and the accumulation of domestic capital sufficient to support larger-scale lending operations. The London goldsmiths, who emerged as significant financial intermediaries during the late 16th and early 17th centuries, represented a crucial transitional stage between medieval moneylending and modern banking, combining the traditional craft of working precious metals with increasingly sophisticated financial services that would eventually transform them into de facto bankers. These craftsmen possessed secure premises with vaults designed to protect valuable metals and finished goods, making them natural depositories for merchants and wealthy individuals seeking safe storage for their cash and valuables in an era when private residences offered limited security against theft or fire. The practice of accepting deposits for safekeeping evolved gradually into the more consequential innovation of lending out a portion of deposited funds while maintaining sufficient reserves to meet normal withdrawal demands, representing a fundamental transformation from passive warehousing to active financial intermediation. The goldsmith bankers of 17th century London discovered through experience that depositors seldom withdrew their entire balances simultaneously, meaning that a substantial portion of deposits could be safely lent to borrowers at interest, generating profits from the spread between the modest interest paid to depositors and the higher rates charged to borrowers. The English Civil War period between 1642 and 1651 accelerated the development of goldsmith banking by disrupting traditional sources of credit and creating urgent demands for liquid capital from both royalist and parliamentary factions seeking to finance military operations. The political instability and the seizure of the Royal Mint at the Tower of London by parliamentary forces in 1642 led many wealthy individuals to transfer their valuables to goldsmith establishments in the city of Innsten, London, where private property rights received greater protection than assets held in royal facilities that had become prizes in the ongoing conflict. The goldsmith Edward Backwell emerged as perhaps the most successful of these banker craftsmen, developing a business that combined traditional metalworking with sophisticated financial operations including foreign exchange, government lending, and the management of complex payment systems for merchants engaged in international trade. Backwell's ledgers, which survived and provide detailed evidence of his operations, reveal a financial institution that accepted deposits, made loans, handled remittances, and conducted foreign exchange transactions in ways that closely resembled modern banking practices, despite operating without formal legal recognition as a bank. The issuance of goldsmith notes represented another crucial innovation that moved England closer to modern banking by creating a form of paper currency backed by deposits held in goldsmith vaults, rather than requiring the physical transfer of coins for each transaction. These notes, which acknowledged the goldsmith's obligation to pay a specified sum on demand to the note holder, could circulate as a medium of exchange among parties willing to accept them based on confidence in the issuing goldsmith's reliability and solvency. The transition from notes payable to a specific named individual to notes payable to bearer marked an important evolution that enhanced the negotiability of these instruments by eliminating the need to verify the identity and legitimate ownership claims of parties presenting notes for payment. The growing acceptance of goldsmith notes as payment instruments reduced the demand for actual coinage in commercial transactions, while increasing the effective money supply beyond the quantity of physical currency in circulation, demonstrating the principle of credit creation that would become central to modern banking theory and practice. The Great Stop of the Exchequer in 1672 represented a catastrophic moment in the development of English banking, when Charles II suspended repayment of government loans, destroying the goldsmith bankers who had advanced substantial sums against anticipated tax revenues. The immediate cause of the suspension was the Crown's inability to maintain debt service, while simultaneously financing the Third Anglo-Dutch War, leading the King's ministers to conclude that default offered a more palatable solution than either raising taxes or abandoning military objectives. The stop devastated several major goldsmith banking houses, including that of Edward Backwell, whose firm never fully recovered from the suspension, despite partial repayments negotiated in subsequent years. The broader impact on English financial development proved complex and contradictory, as the stop simultaneously demonstrated the dangers of lending to government, while revealing the extent to which goldsmith bankers had become essential components of both private commerce and public finance. The subsequent decades saw a partial recovery of goldsmith banking activities, though the stop created lasting skepticism about government creditworthiness that would influence debates about establishing a more formal national bank. The political revolution of 1688 that replaced James II with William III and Mary II created conditions that would lead to the establishment of the Bank of England. As the new monarchs arrived from the Netherlands, with direct experience of more sophisticated continental banking practices, and faced immediate fiscal pressures that required innovative solutions. William's involvement in ongoing European conflicts as stadtholder of the Dutch Republic created military commitments that required funding beyond what traditional revenue sources and short-term expedients could provide, necessitating the development of more permanent mechanisms for government borrowing. The Treasury's attempts to raise loans through traditional means encountered difficulties due to lingering skepticism from the Great Stop and concerns about the new regime's stability, as potential lenders questioned whether a king who had come to the throne through what amounted to a coup would maintain sufficient security of tenure to honor long-term obligations. The proposal to establish a joint stock banking institution that would lend to the government while conducting private banking operations emerged from multiple sources during the early 1690s, with various schemes circulating among merchants, financiers, and government officials seeking solutions to the Crown's fiscal crisis. William Paterson, a Scottish merchant and financial projector who had spent time in continental financial centres, developed the most influential proposal that combined several attractive features, including a substantial loan to government, the creation of a permanent joint stock corporation, and provisions for issuing paper currency that would supplement the inadequate coin supply. The plan involved subscribers contributing a total of £1,200,000 in capital that would be immediately lent to the government at 8% interest, with the interest payments providing the new bank's initial revenue stream, while the capital remained in government hands as a perpetual loan. The subscribers would receive shares in the Bank of England, and the institution would possess authority to issue paper notes, conduct, deposit, and lending operations, and engage in various banking activities that would generate additional profits beyond the interest received from government. The parliamentary debates that preceded the Bank of England's chartering in 1694 revealed deep divisions about the wisdom of creating such an institution, with opponents warning that a permanent national debt would corrupt politics and that a powerful private corporation with government connections would threaten liberty and competition. Supporters countered that the bank offered the only practical means of financing the ongoing war against France, while simultaneously providing benefits to commerce through enhanced credit availability and a more stable currency system. The final charter, approved by Parliament and granted royal assent on July 27, 1694, created a corporation that would endure for more than 3 centuries, though its initial form and powers bore little resemblance to the central bank that would eventually evolve from these modest beginnings. The subscription period for shares in the Bank of England opened on June 21, 1694, and filled rapidly, despite the substantial minimum investment requirement of £500, indicating strong confidence among London's merchant and financial community that the new institution would prove profitable. The Bank of England commenced operations on January 1, 1695, from temporary premises in Mercer's Hall in Cheapside, before moving to Grocers' Hall, and eventually constructing its own building on Threadneedle Street, where it would remain for the next 3 centuries. The bank's early operations focused primarily on managing the government loan that formed its capital base, issuing notes that circulated as currency, and accepting deposits from private customers who valued the security offered by a well-capitalized institution with royal charter protection. The initial note issue proved smaller than anticipated due to legal restrictions and practical difficulties in establishing public confidence in paper currency, though the bank gradually expanded its circulation as merchants and others gained experience with these instruments and recognized their convenience for large transactions. The bank's lending operations included both loans to private parties and discounting of bills of exchange, creating multiple channels through which it could generate revenue beyond the interest received from government, while supporting commercial activity through the provision of credit. The relationship between the Bank of England and the government evolved rapidly during the bank's first decades, as the Treasury discovered that the institution could provide services extending far beyond the original loan that had justified its creation. The bank became the primary manager of government debt, handling the complex administrative tasks associated with receiving subscriptions to new loans, recording ownership of government securities, and making interest payments to holders of various instruments that constituted the burgeoning national debt. The development of systematic procedures for the buying and selling of government debt securities created the foundations of a secondary market that enhanced the liquidity of these instruments while enabling investors to exit positions without waiting for final maturity, innovations that made government borrowing more attractive to potential lenders while reducing the cost of debt service that the Treasury needed to offer. The bank's role as fiscal agent to government generated substantial fee income, while establishing an intimate connection between the institution and the state that would profoundly influence English financial development over subsequent centuries. The recoinage crisis of 1696 created severe economic disruption that demonstrated both the vulnerabilities of a metallic currency system and the Bank of England's importance to financial stability. The English silver coinage had deteriorated through decades of clipping and wear, to the point where many coins contained substantially less silver than their face value implied, creating problems for both domestic commerce and international transactions, as foreign parties discounted English coins based on actual metal content rather than nominal value. The government's decision to recall and remint the entire silver coinage created an immediate liquidity crisis, as the existing coin stock was withdrawn before the new, full-weight coins could be produced and circulated in sufficient quantity. leaving the economy desperately short of the medium of exchange needed for ordinary transactions. The Bank of England provided crucial support during this crisis by expanding its note issue and maintaining credit availability despite the chaos in the monetary system, demonstrating how paper currency, backed by institutional credibility, could substitute for metallic money during periods when the supply of coins proved inadequate. The early 18th century saw the Bank of England establish itself as the dominant institution in London's financial district, while facing competition from both traditional goldsmith bankers and newer corporate rivals, seeking to replicate its successful business model. The South Sea Company, chartered in 1711, ostensibly to develop trade with Spanish South America, but functioning primarily as a mechanism for managing government debt, represented the most significant challenge to the Bank of England's position as the government's primary financial partner. The rivalry between these institutions intensified during the 1720s, as both competed for the privilege of converting government debt into company shares, a process that promised substantial profits through financial engineering that exploited the gap between the interest rates on government securities and the costs of servicing debt held by corporate shareholders. The South Sea Bubble of 1720, in which the South Sea Company's share price rose to astronomical levels before collapsing catastrophically, vindicated the Bank of England's more conservative approach to financial operations, while demonstrating the dangers of speculative excess and fraudulent promotion. The Bank of England's survival of the South Sea Bubble enhanced its reputation for stability and prudent management, while eliminating its most dangerous corporate rival, as the South Sea Company never recovered its financial credibility and gradually transformed into a holding company for government debt rather than an active commercial institution. The subsequent decades saw the bank consolidate its position through steady expansion of its note circulation, growth in its deposit base, and increasing sophistication in its lending and money market operations. The development of regular procedures for discounting bills of exchange drawn on London merchants established the bank as a central node in the commercial credit network that financed England's expanding trade, while the bank's willingness to provide liquidity during periods of financial stress gradually established it as an informal lender of last resort. Despite lacking explicit legal authority or recognition of this function, the bank's physical presence on Threadneedle Street became a symbol of financial solidity and permanence, with the steady expansion of its building reflecting its growing importance to both government and commerce. The country banking sector that emerged outside London during the 18th century represented a parallel development in English banking that addressed credit needs in provincial towns and agricultural regions underserved by metropolitan institutions. These country banks typically began as extensions of other businesses, with merchants, manufacturers, or wealthy landowners adding banking services to their existing commercial operations in response to local demands for credit and payment facilities. The distance from London and the difficulty of maintaining accounts with metropolitan banks made local institutions attractive to provincial customers, requiring routine banking services like accepting deposits, making loans, and facilitating payments between parties within the same region. The legal framework governing country banking remained ambiguous and permissive during much of the 18th century, with relatively few formal restrictions on entry or operations beyond general commercial law provisions regarding fraud, bankruptcy, and contract enforcement. The typical country bank operated as a partnership rather than a corporation, reflecting legal restrictions that limited joint stock banking outside London and the preference of provincial bankers for the flexibility and privacy offered by partnership structures. These institutions generally served local markets intensively, rather than pursuing geographical expansion, with their lending concentrated among borrowers known personally to the partners and secured by local property or agricultural output, whose value the bankers could evaluate based on intimate knowledge of area conditions. The note-issuing activities of country banks created a diverse currency system in which hundreds of different banks circulated their own paper money within their respective trading areas, with the notes of well-regarded banks passing freely at face value, while those of weaker institutions circulated at discounts, reflecting concerns about the issuer's ability to redeem notes in coin on demand. The proliferation of country banks during the late 18th century with their numbers growing from perhaps a dozen institutions in 1750 to several hundred by 1800, demonstrated the expanding credit needs of an economy undergoing agricultural improvement and early industrial development. The financing of agricultural improvement during the 18th century generated sustained demand for medium-term credit that country banks proved well suited to provide, as landowners required capital to fund enclosures, drainage projects, and other enhancements that would increase productivity but required years to generate returns sufficient to repay borrowed funds. The extension of credit secured by land or anticipated agricultural output enabled a more rapid transformation of English farming practices than would have been possible if landowners had been limited to financing improvements from accumulated savings or current income. The country bank's local knowledge enabled them to evaluate agricultural credit risks more effectively than distant London institutions could achieve, giving provincial banks competitive advantages in rural lending that helped establish their market position. The bank's willingness to accept agricultural paper, representing future crops or livestock sales, provided crucial liquidity to farmers between harvest seasons, smoothing the extreme seasonality that characterized agricultural income streams and enabling farm operators to maintain more stable consumption and investment patterns. The early stages of industrial revolution during the late 18th century created additional demands for banking services as manufacturers required working capital to purchase raw materials, finance goods in process, and carry finished inventory until sales could be completed. The expansion of textile manufacturing, iron production, and other industries in regions like Lancashire, Yorkshire, and the Midlands generated concentrations of economic activity that could support specialized banking institutions focused on serving industrial clients. The development of long-term relationships between country banks and industrial borrowers enabled banks to provide credit based on intimate knowledge of customers' businesses and character, rather than relying exclusively on tangible collateral, creating informational advantages that reduced lending risks while enabling manufacturers to access larger credit lines than formal security requirements might have supported. The country banks functioned as crucial intermediaries that mobilized local savings and channeled these funds toward productive investments in agriculture, manufacturing, and commerce that drove regional economic development. The Napoleonic Wars period from 1793 to 1815 subjected English banking to severe strains that exposed vulnerabilities in both the Bank of England and the country banking system, while spurring innovations that would strengthen financial stability in subsequent decades. The demands of wartime finance, including the need to fund British military operations, subsidize continental allies, and maintain naval supremacy, created fiscal pressures that required the Treasury to borrow on an unprecedented scale, while the disruption of international trade and domestic economic dislocation complicated debt service. The Bank of England found itself caught between its obligations to support government borrowing and maintain the convertibility of its notes into gold, with these commitments coming into increasingly sharp conflict as war expenditures drained the nation's metallic reserves and generated inflation that eroded confidence in paper currency. The bank restriction period that began in 1797, when the government authorized the Bank of England to suspend specie payments and refuse to redeem its notes in gold, marked a dramatic departure from the principles that had governed British monetary policy since the bank's founding. The decision to impose restriction resulted from an immediate crisis in February 1797, when concerns about a possible French invasion triggered a run on country banks that spread to the Bank of England itself, threatening to exhaust its gold reserves and force a complete suspension of operations. The government's intervention to authorize inconvertible paper money prevented the bank's collapse, while enabling it to continue providing credit to both government and private borrowers, despite its inability to redeem notes in specie. The restriction period, initially presented as a temporary expedient that would be reversed once the crisis passed, extended for more than 2 decades as wartime conditions persisted and the government proved unwilling to impose the fiscal discipline that resumption of convertibility would have required. The suspension of convertibility generated extensive public debate about monetary principles, with critics arguing that inconvertible paper money inevitably led to inflation and economic distortion, while defenders maintained that the exigencies of wartime finance justified temporary departures from metallic standards. The Bullion Report of 1810 represented the most sophisticated contemporary analysis of monetary conditions during the restriction period, presenting arguments that paper money should bear a stable relationship to the metallic standard, and that excessive note issue by the Bank of England had contributed to inflation and depreciation of the exchange rate. The report, produced by a parliamentary committee that included several members with sophisticated understanding of monetary economics, recommended a return to convertibility as soon as practical, while acknowledging that immediate resumption might prove destabilizing, given the accumulated distortions from nearly 15 years of inconvertible currency. The government's decision to delay implementing the report's recommendations until after the war's conclusion reflected both practical concerns about the disruption that immediate resumption might cause, and political sauve, reluctance to constrain the Bank of England's ability to finance continued military operations. The resumption of cash payments finally occurred in 1821, several years after Waterloo, and following a gradual process of monetary contraction and deflation that brought price levels down toward their pre-war relationship with gold values. The country banking system experienced severe stress during and immediately after the Napoleonic Wars, with numerous failures during the sharp economic contraction that followed the war's end in 1815. The transition from wartime prosperity to peacetime readjustment created deflationary pressures and widespread distress among agricultural and industrial borrowers whose businesses had expanded during the conflict but faced shrinking markets and falling prices once hostilities ceased. Country banks that had extended credit liberally during the boom years found their loan portfolios deteriorating as borrowers defaulted and the collateral securing loans lost value in the deflating economy. The wave of country bank failures during 1815 and 1816 revealed the fragility of institutions operating with limited capital, concentrated local loan portfolios, and circulations of notes that could trigger runs whenever questions arose about a bank's stability. The social and economic disruption caused by these failures intensified public demands for banking reform that would prevent future crises, while maintaining adequate credit availability to support legitimate commercial and industrial self-needs. The passage of banking legislation in 1826 and 1833 represented Parliament's initial attempts to strengthen the banking system through measures that encouraged the formation of larger, better capitalized institutions while maintaining the Bank of England's privileged position. The 1826 Act permitted the establishment of joint stock banks with unlimited liability outside a 65-mile radius from London, creating opportunities for larger banking organizations with more diversified risk profiles than traditional partnership banks could achieve. The legislation reflected a judgment that joint stock organization with broad shareholder bases would create more stable institutions than small partnerships dependent on the resources and judgment of a handful of individuals, while the geographic restriction protected the Bank of England's monopoly in the immediate vicinity of the capital. The 1833 Act refined these arrangements by clarifying that joint stock banks could establish London offices, provided they did not issue notes within the protected radius, enabling provincial joint stock banks to participate directly in the metropolitan money market while continuing their note issue in their home regions. The growth of joint stock banking during the 1830s and 1840s transformed the structure of English provincial banking through the gradual replacement of small partnership banks with larger corporate institutions, possessing more substantial capital bases and more sophisticated management structures. The conversion of existing partnership banks to joint stock organization proceeded through various mechanisms, including outright acquisition by larger institutions, voluntary reorganization that brought in additional shareholders, or the formation of entirely new banks that competed with established partnerships for deposits and lending opportunities. The joint stock banks developed branch networks that extended their reach beyond a single town to cover broader regions, creating economies of scale in operations while diversifying their credit risks across multiple local markets. The enhanced capital and broader shareholder base of joint stock institutions enabled them to attract larger deposits and extend more substantial credits than partnership banks could prudently offer, giving joint stock banks competitive advantages that accelerated their market share growth. The Bank Charter Act of 1844 represented a fundamental reform of English monetary arrangements that reflected the intellectual triumph of the currency school's interpretation of proper central banking principles. The Act, championed by Prime Minister Robert Peel and based on analysis by monetary theorists including Samuel Jones Lloyd, later Lord Overstone, established strict rules governing the Bank of England's note issue while consolidating its position as the dominant force in English banking. The legislation divided the Bank of England into two separate departments, the Issue Department and the Banking Department, with the former holding responsibility for note issue backed by government securities and gold reserves, while the latter conducted normal commercial banking operations, including accepting deposits and making loans. The Act specified that the Issue Department would hold a fiduciary issue of £14 million, backed by government securities, with any note circulation beyond this amount required to be backed 100% by gold reserves held in the department's vaults. The Bank Charter Act's restrictions on note issue by country banks marked the beginning of a gradual process that would eventually concentrate all English currency issue in the Bank of England, as the legislation prevented new banks from acquiring note-issuing privileges and limited existing issuers' circulation to their average issue during the period immediately preceding the Act's passage. The subsequent absorption of note-issuing banks through merger or failure automatically transferred their circulation rights to the Bank of England, creating a ratchet mechanism that systematically centralized currency issue despite the lack of explicit provisions mandating immediate nationalization of note issue. The theoretical foundation for these restrictions rested on the currency school's doctrine that note circulation should fluctuate automatically with the gold reserve in order to prevent the monetary instability that supposedly resulted from discretionary management of inconvertible paper money. The strict rules governing note issue aimed to create an automatic monetary system that would eliminate the possibility of inflationary excess or deflationary contraction resulting from central bank errors or political pressures. The practical operation of the Bank Charter Act system generated several serious financial crises during the subsequent decades, demonstrating that rigid rules governing monetary arrangements could prove destabilizing when confronted with emergency conditions requiring flexibility and discretion. The crisis of 1847, the first major test of the Act's provisions, resulted from a combination of commercial distress following railway speculation, poor harvests that required substantial grain imports, and the rigid monetary restrictions that prevented the Bank of England from expanding credit to support the financial system. The government's decision to suspend the Bank Charter Act during the crisis, authorizing the Bank of England to issue notes beyond the limits specified in the Act, enabled the institution to provide the liquidity necessary to stabilize financial markets and prevent a cascading series of failures that threatened to paralyze commerce. The government's willingness to suspend the Act's restrictions during the crises of 1857 and 1866 established a pattern in which Parliament maintained the theoretical framework of automatic monetary rules while reserving the practical flexibility to authorize departures from these restrictions when emergencies demanded. The development of a more integrated national banking system during the mid-19th century proceeded through the expansion of branch networks that connected provincial centres with London money markets and through the growth of correspondent relationships that enabled country banks to access metropolitan financial services. The telegraph's introduction during the 1850s enhanced the speed and reliability of financial communications between London and provincial centres, enabling country banks to transmit orders to their London correspondents and receive information about market conditions with unprecedented rapidity. The improved communications encouraged the centralization of reserves in London rather than their dispersal among provincial institutions. As country banks gained confidence that they could access their metropolitan balances quickly when local demands for currency or credit emerged. The concentration of banking reserves in London created a more efficient system for mobilizing resources to address localized problems, while simultaneously creating vulnerabilities associated with the dependence of the entire provincial banking system on the stability of the London money market. The evolution of the London money market during the Victorian period created increasingly sophisticated mechanisms for the short-term allocation of capital among banks, discount houses, and other financial institutions with temporary imbalances between their assets and liabilities. The discount houses emerged as specialized intermediaries that purchased commercial bills from banks and other holders, financing these acquisitions through very short-term borrowing in the cool money market, where banks placed funds available for lending at daily notice. The Bank of England's position in this market structure evolved gradually from that of an ordinary market participant to that of ultimate provider of liquidity during periods of market stress, though the bank's leadership resisted explicit recognition of central banking responsibilities and often hesitated to provide support on terms that market participants found acceptable. The development of the doctrine that the Bank of England should serve as lender of last resort, providing unlimited liquidity against good security during financial panics, while simultaneously charging penalty rates to discourage excessive reliance on central bank support, emerged from the analysis of banking crises by Walter Bagehot and others during the 1860s and 1870s. The publication of Bagehot's Lombard Street in 1873 provided the most influential exposition of proper central banking principles during financial crises, arguing that the Bank of England must abandon its traditional reluctance to lend freely during panics and instead provide whatever liquidity the market required to prevent the collapse of fundamentally sound institutions caught in temporary liquidity squeezes. Bagehot's prescription that central banks should lend freely against good collateral at penalty rates during crises became a foundational principle of central banking theory, though its implementation required the Bank of England to overcome institutional conservatism and shareholder concerns about the risks associated with expanded crisis lending. The bank's gradual acceptance of lender of last resort responsibilities reflected both the intellectual influence of Bagehot's analysis and the practical experience of successive crises that demonstrated the devastating economic consequences of allowing financial panics to run their course without official intervention. The development of procedures for providing emergency liquidity while maintaining pressure on banks to hold adequate precautionary reserves represented a crucial evolution in central banking practice that would influence financial stability arrangements throughout the developed world. The late Victorian period witnessed continued consolidation within English banking through mergers that created larger institutions with nationwide branch networks capable of serving customers across broad regions rather than remaining confined to particular localities. The technological improvements in communications and transportation that characterized the period enabled banks to manage geographically dispersed operations more effectively than had been possible earlier in the century, when slower information flows and higher coordination costs favored locally focused institutions. The legal framework governing bank mergers evolved to facilitate consolidation through the recognition that larger, more diversified institutions possessed inherent stability advantages over smaller banks with concentrated exposure to particular industries or regions. The amalgamation movement that began during the 1860s accelerated through subsequent decades as successful banks acquired smaller competitors or merged with roughly equal partners to create institutions of steadily increasing scale and market power. The formation of several large joint stock banks that would dominate English banking for the next century occurred primarily through this merger process, with institutions like the Midland Bank, Lloyds Bank, Barclays Bank, and Westminster Bank emerging from the combination of numerous predecessor institutions. The Midland Bank's rise to become England's largest bank by the early 20th century exemplified the potential of aggressive expansion through strategic acquisitions, combined with innovation in retail banking services aimed at attracting middle-class customers. The bank's decision to offer checking accounts and other services to a broader range of customers than traditional banks had served helped democratize banking beyond the wealthy merchants and manufacturers who had formed the core clientele of earlier banking institutions. The expansion of branch networks brought banking services to smaller towns and working-class neighborhoods that had previously lacked access to formal financial institutions, integrating larger portions of the population into the banking system while providing banks with more diversified deposit bases. The development of specialized banking institutions during the Victorian period addressed financial needs that the established commercial banks either could not or would not serve adequately, leading to the emergence of merchant banks, savings banks, and building societies that occupied distinct niches within the broader financial system. The merchant banks that operated primarily in the City of London focused on international finance, including the underwriting and distribution of foreign government bonds, financing of international trade through the acceptance of bills of exchange, and the management of complex foreign exchange transactions. Houses like Rothschild's, Barings, Hambros, and Schroders possessed international networks and specialized expertise that enabled them to dominate the lucrative business of financing global commerce and channeling British capital to borrowers around the world. The British Empire's expansion during the 19th century created enormous opportunities for merchant banks to arrange financing for colonial governments, railway construction, mining ventures, and plantation agriculture throughout Asia, Africa, and the Americas, with London emerging as the dominant centre for international finance based on its combination of capital abundance, sophisticated financial markets, and the global reach of British commercial and political influence. The savings bank movement that had originated in the early 19th century as a philanthropic effort to encourage thrift among working people evolved into a significant component of the retail banking system, with hundreds of institutions accepting small deposits and investing these funds in government securities or other safe assets. The trustee savings banks operated under special legal provisions that guaranteed their deposits through government backing, while restricting their investment activities to ensure that depositors' funds remained secure, creating institutions that served primarily as safe repositories for small savers, rather than as active lenders to commerce or industry. The Post Office Savings Bank, established in 1861, extended savings facilities to virtually every community in the country through the existing network of post offices, providing convenient access to basic savings services for people living in areas too small to support dedicated banking institutions. The combination of government guarantee, widespread geographic access, and simple procedures made postal savings accounts attractive to small savers, despite the modest interest rates that these accounts offered, contributing to the steady increase in working-class savings rates during the late Victorian period. The building society movement addressed the specific credit needs of middle-class and working-class households seeking to purchase homes through the provision of long-term mortgage finance unavailable from commercial banks, which traditionally avoided real estate lending except for short-term accommodation secured by commercial property. The building societies originated as mutual organizations in which members pooled their savings to fund mortgage loans to fellow members, with the societies often dissolving once all members had achieved home ownership or choosing to continue operations as permanent institutions accepting deposits from the general public. The legal framework governing building societies emphasized their mutual character and restricted their activities to residential mortgage lending, preventing them from competing directly with commercial banks in business lending or offering the full range of banking services. The growth of building societies during the late 19th and early 20th centuries reflected the expanding demand for owner-occupied housing, as rising real incomes enabled more families to contemplate home purchase, while urbanization created concentrated populations capable of supporting specialized mortgage lending institutions. The Edwardian period witnessed the continuation of banking consolidation trends that had characterized the late Victorian years, with the number of independent banking institutions steadily declining as mergers created ever larger organizations dominating increasingly broad market areas. The process reached a critical point during and immediately after World War I, when a wave of major mergers threatened to reduce English banking to a small handful of giant institutions possessing potentially dangerous monopoly power. The Treasury Committee on Bank Amalgamations, established in 1918 to examine the consolidation trend and its implications for competition and financial stability, recommended that further large mergers should be subject to government approval to prevent excessive concentration that might harm public interests. The subsequent decades saw the emergence of the Big Five banks that collectively dominated English commercial banking through their extensive branch networks and substantial capital bases, with Midland Bank, Lloyds Bank, Barclays Bank, Westminster Bank, and National Provincial Bank together controlling the vast majority of deposits and lending activity by the interwar period. The First World War's impact on English banking extended far beyond accelerating consolidation to encompass fundamental changes in the relationship between banks and government, the structure of international finance, and the role of the Bank of England in economic management. The Treasury's need to finance unprecedented military expenditures required the mobilization of the banking system to facilitate government borrowing through the purchase of war bonds and the marketing of these securities, public through bank branch networks. The Bank of England's role expanded dramatically during the conflict as the institution assumed responsibility for managing the government's financing operations, coordinating foreign exchange controls, and maintaining essential financial services despite the disruption of normal market mechanisms. The suspension of the gold standard at the war's outbreak freed monetary policy from the constraints of maintaining fixed exchange rates, enabling the Bank of England to support war finance through expansionary credit policies that would have been impossible under the pre-war international gold standard system. The post-war return to the gold standard in 1925 at the pre-war parity represented a triumph of financial orthodoxy that reflected the belief that restoring traditional monetary arrangements would facilitate the resumption of normal international commerce and investment. The decision to return to gold at the old parity, rather than devaluing to reflect the wartime inflation, proved controversial at the time, and has remained subject to historical debate, with critics arguing that the overvalued exchange rate handicapped British exports and contributed to the persistently high unemployment that characterized the 1920s. The Bank of England's monetary policy during the 20s aimed to maintain the gold standard commitment while supporting domestic economic activity, objectives that came into increasingly sharp conflict as the overvalued pound required high interest rates to prevent gold outflows, while high unemployment called for expansionary policies to stimulate demand. The intellectual framework guiding monetary policy during this period emphasized the importance of maintaining international confidence in sterling and preserving London's position as a global financial centre, priorities that took precedence over domestic employment concerns in the judgments of Bank of England officials and Treasury authorities. The Great Depression's arrival in 1929 and its intensification during the subsequent years subjected English banking to pressures comparable to those experienced during previous financial crises, while occurring within an international context of unprecedented economic collapse that overwhelmed traditional crisis management mechanisms. The banking system's initial resilience during the early stages of the Depression reflected the strength that decades of consolidation had created, as the large joint stock banks possessed sufficient capital and diversified portfolios to absorb substantial loan losses without facing immediate solvency threats. The crisis that forced Britain to abandon the gold standard in September 1931 resulted not from domestic banking problems, but from international financial pressures associated with the European banking crisis, speculation against sterling by foreign exchange market participants, doubting Britain's ability to maintain the gold standard commitment. The Bank of England's unsuccessful attempt to defend the pound through massive gold sales that exhausted its reserves demonstrated the limits of even the most powerful central bank's capacity to maintain fixed exchange rates when, confronted with determined selling pressure backed by substantial financial resources. The departure from gold in 1931, while initially perceived as a humiliating defeat for British financial policy, ultimately provided monetary authorities with flexibility to pursue expansionary policies that would have been impossible under gold standard constraints. The floating exchange rate regime that followed the pound's devaluation enabled the Bank of England to reduce interest rates and support domestic credit expansion without triggering the gold outflows that had constrained policy under Support BES. The fixed exchange rate system. The government's establishment of the Exchange Equalisation Account in 1932 provided a mechanism for managing the floating pound's value through intervention in foreign exchange markets, creating a middle path between rigidly fixed rates and completely unmanaged floating. The cheap money policy pursued during the 1930s, with bank rate maintained at 2% from June 1932 through August 1939, facilitated economic recovery through supporting housing construction, refinancing government debt at lower interest rates, and encouraging industrial investment despite the persistent unemployment that characterized the decade. The interwar period witnessed significant changes in the regulatory framework governing English banking, though the approach remained characteristically informal and reliant on cooperation between the Bank of England and commercial banks, rather than on detailed statutory requirements. The Bank of England's enhanced role in supervising commercial banks reflected both its evolution toward explicit central banking responsibilities and the recognition that financial stability required ongoing monitoring of major institutions' condition and practices. The informal nature of supervision during this period meant that the Bank of England relied primarily on moral suasion and periodic consultations with bank leadership, rather than formal examinations or detailed reporting requirements of the type that characterized banking regulation in other jurisdictions. The system operated effectively during normal times, when banks maintained conservative practices and adequate capital voluntarily, though its limitations would become apparent during later periods, when more aggressive banking strategies and complex financial innovations created risks that informal supervision proved inadequate to address. The outbreak of World War II in September 1939 initiated another period of comprehensive government control over banking and finance, as the Treasury and Bank of England mobilized the financial system to support the 2024 war effort. The banking system's role in war finance included facilitating government borrowing through the purchase and distribution of war bonds, managing foreign exchange controls that limited capital outflows and directed resources toward essential imports, and maintaining payment systems essential for domestic economic activity. The close cooperation between government and banks during the war years represented an intensification of relationships that had developed during World War I, with the banking system effectively operating as an instrument of state policy while maintaining its private ownership structure. The controls imposed during the war included restrictions on bank lending for non-essential purposes, requirements that banks hold specified portions of their assets in government securities, and detailed oversight of foreign exchange transactions to prevent capital flight and ensure efficient allocation of scarce foreign currency. The post-war Labour government's nationalisation of the Bank of England in 1946 represented a relatively limited change in practical terms, as the bank had long functioned as an instrument of government policy and maintained close working relationships with Treasury officials that made formal state ownership largely symbolic. The Bank of England Act 1946 transferred the bank's shares from private shareholders to Treasury ownership, while maintaining the institution's operational independence in conducting day-to-day monetary policy and supervising commercial banks. The nationalisation reflected the Labour government's ideological commitment to public ownership of key economic institutions, while acknowledging that the bank's functions required some degree of operational autonomy that complete integration into the civil service would have compromised. The commercial banking sector remained in private hands despite pressures from Labour's left wing for comprehensive nationalisation, with the government instead relying on controls over bank lending and requirements for holding government securities to influence commercial bank behaviour in directions consistent with economic planning objectives. The post-war decades witnessed the continued dominance of the Big Five clearing banks over English commercial banking, with these institutions maintaining the extensive branch networks and conservative lending practices that had characterized the sector during the interwar period. The clearing bank's central role in the payments system gave them enormous influence over commerce and finance, as virtually all significant economic transactions involved transfers between accounts held at clearing bank branches. The bank's oligopolistic market structure enabled them to maintain comfortable profit margins through coordinated pricing of services and limitation of competition for deposits or loans, with the Bank of England playing an informal coordinating role that encouraged stability over aggressive competition. The controls on bank lending that governments maintained through much of the post-war period reflected both the Keynesian economic policy framework that emphasized demand management and the specific goal of directing credit toward productive investments in manufacturing and away from consumer spending or property speculation. The gradual relaxation of direct credit controls during the 1950s and early 1960s occurred within a broader pattern of alternating between restriction and relaxation, as successive governments attempted to manage the economy, through short-term adjustments, to credit availability. The stop-go cycle that characterized British economic policy during this period involved periodic restrictions on bank lending to cool inflation and protect the balance of payments, followed by relaxation once unemployment rose or growth slowed, creating an unstable policy environment that complicated long-term business planning. The clearing bank's response to these controls involved various adaptations, including the development of parallel markets for wholesale deposits and the expansion of lending through non-traditional channels that fell outside the scope of quantitative restrictions. The growth of the Eurodollar market in London during the 1960s provided British banks with access to dollar-denominated deposits and lending opportunities that lay beyond the reach of sterling controls, contributing to London's revival as an international financial centre, despite Britain's relatively modest role in global trade compared to the pre-war period. The competition and credit control reforms introduced by the Bank of England in 1971 represented a fundamental shift toward greater reliance on market forces and away from the direct controls that had characterized post-war regulatory approach. The reforms eliminated the quantitative ceilings on bank lending that had been a primary instrument of monetary policy, replacing them with reliance on interest rates and reserve requirements to influence credit conditions. The Bank of England's adoption of a new monetary base control system aimed to provide more precise control over the money supply while enabling greater competition among banks for deposits and lending opportunities. The relaxation of the interest rate cartel that had coordinated clearing bank deposit and lending rates enabled more aggressive price competition while encouraging the entry of new competitors, including foreign banks establishing London, operations and building societies expanding beyond their traditional mortgage lending focus. The liberalization of credit markets during the early 1970s contributed to a substantial expansion in bank lending that fueled property market speculation and ultimately required the Bank of England to mount a lifeboat rescue operation for secondary banks threatened with failure during the property crash of 1973 and 1974. The secondary banking crisis demonstrated the risks associated with rapid deregulation implemented without adequate supervisory safeguards, as numerous smaller institutions that had expanded aggressively during the credit boom found themselves overexposed to falling property values and unable to roll over the wholesale deposits that had funded their lending. The Bank of England's response involved organising support operations in which the major clearing banks provided liquidity to troubled secondary banks under implicit guarantees that the Bank of England would absorb any losses resulting from these rescue operations. The crisis management approach reflected the central bank's long-standing preference for informal arrangements and cooperation among market participants, rather than formal resolution procedures or legislative frameworks, though the scale of intervention required raised questions about the adequacy of existing supervisory mechanisms. The Banking Act 1979 represented Parliament's first comprehensive statutory framework for bank supervision, establishing formal licensing requirements, prudential standards, and enforcement powers that replaced the informal oversight relationships that had characterized previous regulatory practice. The Conservative government elected in 1979 under Margaret Thatcher's leadership initiated a period of dramatic change in English banking through policies emphasizing deregulation, privatization, and increased competition. The abolition of exchange controls in October 1979 removed restrictions on capital movements that had channeled British savings toward domestic investment, while limiting British investors' ability to diversify internationally, creating new opportunities for banks to develop international services and compete for cross-border business. The deregulation of mortgage lending during the early 1980s enabled banks to compete directly with building societies in residential mortgage markets previously dominated by mutual institutions, leading to rapid growth in bank mortgage lending as institutions sought to deploy their substantial deposit bases in a profitable asset class. The Building Societies Act 1986 expanded the powers of these mutual institutions to offer checking accounts and unsecured lending while maintaining their primary focus on mortgage finance, blurring the traditional distinctions between banks and building societies that had characterized the English financial system. The Big Bang reforms implemented in October 1986 transformed the structure of London's financial markets through the abolition of fixed commissions on securities trading, the elimination of distinctions between brokers and dealers, and the opening of London Stock Exchange membership to corporate ownership, including banks and foreign firms. The reform's immediate impact included the acquisition of most traditional stockbroking firms by large banks seeking to establish integrated investment banking operations, combining securities, trading, underwriting, and corporate advisory services. The rapid consolidation of London's financial markets and the entry of well-capitalized international competitors transformed the city from a collection of small partnerships operating through personal relationships and tradition to a market dominated by large financial conglomerates employing modern technology and pursuing global strategies. The clearing bank's expansion into investment banking through acquisitions of securities firms created universal banking organizations offering comprehensive financial services across commercial banking, investment banking, and asset management. Though the integration of these diverse businesses proved challenging, and several banks eventually retreated from investment banking after suffering substantial losses. The financial deregulation of the 1980s occurred against a background of rapid technological change that transformed the operational structure of banking through the introduction of automated teller machines, electronic funds transfer systems, and eventually internet banking that reduced the importance of physical branch networks. The widespread adoption of ATMs during the 1970s and 1980s enabled banks to provide 24-hour access to cash withdrawal and basic account services, while reducing labor costs associated with routine teller transactions. The development of electronic payment systems, including BACS for direct deposits and automated clearing, CHAPS for same-day large-value transfers, and eventually real-time gross settlement systems enhanced the speed and efficiency of payments, while reducing the risks associated with paper check clearing. The technological investments required to develop and operate these systems created scale economies that reinforced the dominance of large banks, while creating barriers to entry for potential competitors lacking the capital and technical expertise to build compatible systems. The consolidation of English banking continued during the 1980s and 1990s through mergers that combined major clearing banks into larger organizations, pursuing both domestic market dominance and international expansion. The merger of Midland Bank and Hong Kong and Shanghai Banking Corporation in 1992 represented the acquisition of one of the historic Big Five banks by a foreign institution, marking a significant shift in the ownership structure of English banking. The consolidation of Lloyds and TSB in 1995 created Britain's largest retail banking organisation, measured by branch numbers and deposit market share. Combining Lloyds' traditional clearing bank business with TSB's extensive retail network, developed from the trustee savings bank movement. The subsequent merger wave during the late 1990s saw the formation of several financial supermarkets that combined retail banking, investment banking, asset management, and insurance within integrated organizations, pursuing strategies of comprehensive financial service provision to both individual and corporate customers. The regulatory framework governing English banking evolved substantially during the 1990s in response to both domestic policy developments and international harmonization efforts aimed at creating more consistent standards across major financial centers. The implementation of Basel Capital Accord requirements, which established minimum capital ratios for international banks, provided a common framework for assessing bank solvency while enabling competition across jurisdictions without creating opportunities for regulatory arbitrage through establishment of operations in locations with minimal capital requirements. The creation of the Financial Services Authority in 1997 through consolidation of various specialized regulators represented a move toward integrated supervision of banks, securities firms, and insurance companies within a single regulatory body possessing comprehensive authority over the financial sector. The transfer of banking supervision from the Bank of England to the FSA marked a significant change in the central bank's role, with the Bank of England retaining responsibility for monetary policy while relinquishing the supervisory functions it had exercised over banks since the 19th century. The new Labour government's grant of operational independence to the Bank of England in 1997 for the conduct of monetary policy represented a culmination of debates about central bank independence that had intensified during the 1980s, as academic research suggested that independent central banks achieved better inflation outcomes than those subject to direct political control. The establishment of the Monetary Policy Committee with explicit responsibility for setting interest rates to achieve a specific inflation target created a transparent framework for monetary policy that contrasted sharply with the informal arrangements and undisclosed decision-making that had characterized previous decades. The MPC's structure, which combined Bank of England officials with external members appointed for their economic expertise, aimed to balance institutional knowledge with outside perspectives, while ensuring that monetary policy decisions reflected technical economic judgments rather than short-term political considerations. The inflation targeting framework, which specified a 2% target for the Consumer Price Index, with requirements for written explanation if inflation diverged from target by more than 1 percentage point in either direction, provided clear accountability mechanisms while allowing flexibility in the path toward achieving the target. The period between the Bank of England's gaining independence in 1997 and the onset of the global financial crisis in 2007 has been characterized as the Great Moderation, a period of steady economic growth, low inflation, and apparent financial stability that created confidence in the effectiveness of the new monetary policy framework. The benign economic conditions during this period reflected both skillful monetary policy management and favorable global developments, including the integration of China and other emerging markets into the world trading system, which generated disinflationary pressures that helped maintain price stability despite strong domestic demand. The stability in inflation and output enabled sustained growth in credit and asset prices as banks expanded lending against appreciating collateral values, while maintaining capital ratios that appeared adequate by regulatory standards but would prove insufficient when conditions deteriorated. The development of complex securitization structures that enabled banks to originate loans and distribute the associated risks to investors through sales of mortgage-backed securities and other structured products created apparent opportunities to expand lending while managing balance sheet risks, though the opacity of these structures and the complexity of the underlying risk transfers would contribute to the subsequent crisis. The global financial crisis that began in 2007 exposed fundamental weaknesses in both the structure of English banking and the regulatory framework that had evolved during previous decades. The Northern Rock crisis in September 2007 marked the first run on a British bank since the 19th century, with depositors queuing outside branches to withdraw funds after concerns emerged about the bank's funding model that relied heavily on wholesale market borrowing rather than retail deposits. Northern Rock's business strategy of aggressive mortgage lending, funded through securitization and short-term wholesale borrowing, had appeared profitable and sustainable during benign market conditions, but proved catastrophically vulnerable when credit markets froze and the bank could no longer roll over its wholesale funding. The Bank of England's initial reluctance to provide emergency liquidity assistance on terms that Northern Rock found acceptable reflected concern about moral hazard and the precedent that generous emergency lending might establish, though this caution proved counterproductive when news of the bank's difficulties leaked and triggered the very confidence crisis that lender of last resort support aims to prevent. The nationalisation of Northern Rock in February 2008, after efforts to arrange a private sector acquisition failed, represented an extraordinary intervention that reflected both the immediate crisis and the government's judgment that the bank's failure would create unacceptable risks to financial stability. The decision to take the bank into public ownership, rather than allowing it to fail and enter administration-protected depositors and prevented potential contagion to other institutions, though it also created substantial costs for taxpayers who absorbed losses on the bank's mortgage portfolio when property values declined during the subsequent recession. The Northern Rock episode demonstrated serious deficiencies in the tripartite regulatory system that divided responsibility for financial stability among the Treasury, Financial Services Authority, and Bank of England, with unclear lines of authority and inadequate coordination contributing to delays and confusion in the initial crisis response. The intensification of the global financial crisis following the collapse of Lehman Brothers in September 2008 created threats to the entire English banking system that required unprecedented government intervention to prevent complete collapse. The deterioration of major banks' capital positions as loan losses mounted and assets held for trading purposes lost value created solvency concerns that triggered sharp declines in bank share prices and raised questions about whether several major institutions possessed adequate capital to continue operations. The government's bank rescue package announced in October 2008 involved direct capital injections through purchases of preference shares, guarantees of bank debt issuance to enable institutions to refinance maturing obligations, and the creation of asset protection schemes that would shield banks from losses on specified portfolios of troubled loans. The scale of government support extended to the banking system ultimately exceeded £2 trillion when direct capital injections, guarantees, and asset protection schemes were included, representing an extraordinary commitment of public resources to prevent financial collapse. The nationalisation of Royal Bank of Scotland and Lloyds Banking Group through government acquisition of controlling equity stakes represented a dramatic reversal of the privatisation policies that had characterised British economic policy during previous decades. RBS's near collapse resulted from its acquisition of ABN AMRO in 2007, immediately before the crisis, a transaction that loaded the bank with substantial troubled assets while consuming capital that would prove desperately needed when conditions deteriorated. The government's decision to inject £84 billion of capital into RBS and acquire an 84% ownership stake prevented the bank's failure, while creating questions about how a partially nationalised bank should be managed and when the government might be able to exit its ownership position. Lloyds Banking Group's crisis reflected both losses on its traditional business and its acquisition of HBOS, a troubled competitor whose mortgage and commercial real estate exposures generated substantial losses during the downturn, with the government acquiring 43% of Lloyds shares through capital injections totaling £20 billion. The regulatory reforms implemented following the financial crisis aimed to address the structural weaknesses and supervisory failures that had contributed to the crisis, while creating more resilient banking institutions, better able to withstand future shocks. The Independent Commission on Banking, chaired by Sir John Vickers and reporting in 2011, recommended structural separation of retail banking from investment banking through ring-fencing requirements that would insulate deposit-taking and payment services from trading activities and wholesale banking operations. The Commission's analysis concluded that the combination of retail and investment banking within universal banking organizations created excessive complexity, interconnectedness, and implicit government guarantees that encouraged excessive risk-taking while making effective supervision extremely difficult. The ring-fencing recommendations, implemented through legislation passed in 2013 and made effective in 2019, required major banks to establish separate legal entities for retail banking operations with independent capital, governance, and risk management that would enable retail banks to continue functioning even if investment banking affiliates encountered severe difficulties. The substantial increase in capital requirements imposed on banks following the crisis reflected international agreements developed through the Basel Committee on Banking Supervision that established higher minimum capital ratios, introduced new buffers for systemically important institutions, and created stricter definitions of what counted as regulatory capital. The implementation of Basel III standards during the period following 2013 increased the minimum common equity requirement to 7% of risk-weighted assets for systemically important banks, up from the 2% required under previous rules, while introducing leverage ratio requirements that limited total assets regardless of their risk characteristics. The enhanced capital requirements aimed to ensure that banks possessed sufficient loss-absorbing capacity to survive severe stress scenarios without requiring government bailouts, though the higher capital requirements also raised questions about potential impacts on lending availability and economic growth. The creation of the Prudential Regulation Authority and Financial Conduct Authority, to replace the Financial Services Authority, represented a restructuring of financial supervision that aimed to address weaknesses exposed during the GRES crisis. The division of responsibilities between the PRA, focused on prudential supervision of banks and insurance companies, and the FCA, responsible for conduct regulation and consumer protection across financial services, reflected judgments that these distinct regulatory objectives required different approaches and institutional cultures. The return of prudential supervision to the Bank of England through the PRA's establishment as a subsidiary of the central bank reversed the separation of monetary policy and banking supervision implemented in 1997, based on arguments that financial stability required close coordination between monetary policy and prudential supervision that the tripartite system had failed to provide. The introduction of stress testing as a core supervisory tool represented another significant innovation in banking regulation following the crisis, with annual exercises examining whether major banks possessed adequate capital to survive hypothetical severe adverse scenarios, including sharp recessions, substantial declines in property values, and disruptions to wholesale funding markets. The stress test scenarios, designed to be more severe than conditions experienced during historical crises, required banks to project their capital positions under stress and demonstrate capacity to maintain lending even when absorbing substantial losses. The publication of stress test results enhanced transparency around bank resilience while creating market discipline that encouraged institutions to maintain stronger capital positions than formal minimum requirements specified. The findings that several banks failed initial stress tests and required additional capital raising demonstrated both the value of the exercise in identifying weaknesses and the substantially strengthened position of the banking system relative to pre-crisis conditions. The conduct scandals that emerged during and after the financial crisis revealed serious deficiencies in bank culture and governance that had enabled widespread misconduct, including manipulation of benchmark interest rates, mis-selling of payment protection insurance and interest rate hedges, and failures in money laundering controls. The LIBOR manipulation scandal, which came to light in 2012, revealed that traders at major banks had colluded to manipulate the London Interbank Offered Rate, a crucial benchmark used to set rates on trillions of dollars of financial contracts in order to benefit their trading positions and create false impressions of their institution's funding costs. The payment protection insurance scandal involved banks selling insurance against loan default to millions of customers who did not need the coverage, could not claim benefits, or were not adequately informed about policy terms and limitations, resulting in compensation payments ultimately exceeding £50 billion. The cumulative effect of these conduct failures severely damaged public trust in banking while imposing substantial financial costs on institutions through regulatory fines, compensation payments, and legal settlements. The regulatory response to conduct failures included both substantially increased penalties for misconduct and new frameworks aimed at improving bank culture and individual accountability. The Senior Managers and Certification Regime, introduced in 2016, created requirements for clear allocation of responsibilities among senior bank executives, with individuals facing potential prohibition from working in financial services if they fail to fulfill their obligations with due skill, care, and diligence. The regime represented a shift from the light-touch regulation that had characterized the pre-crisis period toward more intrusive oversight of bank governance and culture, with regulators conducting detailed reviews of firms' conduct risk frameworks and taking enforcement action against individuals as well as institutions. The substantial fines imposed on both banks and individuals for misconduct reflected regulators' determination to use available enforcement tools to deter future violations, while sending clear messages that serious consequences would follow breaches of regulatory requirements. The Brexit referendum result in June 2016 and the subsequent departure of the United Kingdom from the European Union in January 2020 created substantial uncertainty for English banking, given London's position as the financial centre for European capital markets and the integrated nature of financial regulation across the EU. The loss of passporting rights that had enabled UK banks to operate throughout the European Economic Area based on authorization from UK regulators, required firms to establish subsidiaries in EU member states and transfer substantial operations and staff to continental locations. The relocation of trading activities, asset management operations, and support functions from London to financial centres, including Frankfurt, Dublin, Paris, and Amsterdam, represented a partial reversal of the concentration of European financial activity in London that had characterised previous decades. The UK government's efforts to negotiate continued access to European markets through equivalence determinations and other arrangements achieved limited success, with the EU adopting a cautious approach to granting UK firms access, given its interest in developing its own financial sector and its concerns about maintaining regulatory alignment post-Brexit. The COVID pandemic that emerged in early 2020 subjected English banking to another severe test as economic lockdowns, widespread business failures, and soaring unemployment threatened to generate massive loan losses that would deplete bank capital and potentially trigger another systemic crisis. The government's response included loan guarantee schemes that encouraged banks to continue lending to businesses affected by pandemic disruptions, while reducing the credit risk that banks assumed on these exposures, with the Treasury guaranteeing 80 to 100% of losses on various categories of pandemic-related lending. The substantial take-up of these guarantee schemes, with more than £100 billion of guaranteed lending provided during 2020 and 2021, demonstrated both the severity of the shock that businesses faced and the effectiveness of the schemes in maintaining credit availability during the crisis. The regulatory forbearance provided to banks during the pandemic, including permission to utilize capital and liquidity buffers built up during the post-crisis period, enabled institutions to absorb losses and continue lending rather than contracting credit to preserve capital ratios. The relatively smooth functioning of the banking system during the COVID crisis, in sharp contrast to the chaos of 2008, reflected both the stronger capital positions that banks had built following the financial crisis and the more effective crisis response enabled by lessons learned from previous episodes. The bank's ability to process massive increases in loan applications, implement payment holidays for affected borrowers, and maintain essential services despite staff working remotely, demonstrated improvements in operational resilience and technology infrastructure developed during preceding years. The avoidance of bank failures or nationalization during the pandemic validated the post-crisis reforms that had increased capital requirements, enhanced supervision, and created resolution frameworks that reduced both the likelihood and potential impact of bank distress. The experience reinforced the importance of maintaining strong capital positions during benign conditions to create buffers that could be utilized during stress periods, a lesson that some critics of higher capital requirements had questioned during the implementation of post-crisis reforms. The rise of financial technology companies offering banking services through digital platforms represents a contemporary challenge to traditional banking institutions that have relied on branch networks and established customer relationships. The emergence of digital-only banks, including Monzo, Revolut, and Starling Bank during the period following 2015, demonstrated consumer appetite for mobile-first banking services that emphasize user experience and real-time account management over physical presence. The digital bank's ability to offer competitive products without the cost structure associated with branch networks enabled aggressive pricing and rapid customer acquisition, though questions remained about their long-term profitability and ability to survive an economic downturn without the diversified revenue sources and established deposit bases of traditional banks. The regulatory approach to fintech has balanced promotion of innovation and competition with maintenance of safety and soundness standards, with the Financial Conduct Authority creating a regulatory sandbox that enables firms to test new products under controlled conditions before full commercial launch. The development of open banking frameworks requiring established banks to share customer data with authorized third-party providers through standardized application programming interfaces aims to enhance competition by enabling new entrants to build services utilizing customer financial data held by traditional banks. The implementation of open banking requirements during 2018 under the revised Payment Services Directive created obligations for major banks to provide real-time access to account information and payment initiation services. When customers authorize such access, reducing barriers to entry for firms lacking direct access to payment systems or customer transaction data. The early applications of open banking have focused primarily on account aggregation services, enabling consumers to view all their financial accounts in a single interface, and comparison services that analyze transaction data to identify opportunities for savings on routine expenses. The potential for more transformative applications, including automated financial management, alternative credit assessment methodologies, and seamless integration of financial services into non-banking platforms, remains largely unrealized, though continued development may eventually substantially alter the structure of retail banking. The challenges facing English banking in the contemporary period reflect both long-standing structural issues and emerging threats associated with technological change, climate risk, and evolving customer expectations. The persistently low interest rate environment that has characterized the post-crisis period compressed banks' net interest margins as the gap between deposit rates and lending rates narrowed, putting pressure on profitability of traditional lending activities. The shift toward negative interest rates in some jurisdictions and discussions of similar policies in the UK during periods of economic stress raised questions about the sustainability of traditional banking business models that assume positive returns on loan portfolios. The search for alternative revenue sources has driven banks toward greater emphasis on fee-based services, including payments, wealth management, and insurance distribution, though these activities also face competitive pressures from specialized providers and technology platforms. The growing recognition of climate change as a source of financial risk has prompted regulators to require banks to assess and disclose their exposure to both physical risks from extreme weather events and transition risks from the shift toward a low-carbon economy. The Prudential Regulation Authority's supervisory expectations regarding climate risk management require major banks to incorporate climate scenarios into their strategic planning, risk management frameworks, and capital adequacy assessments. The introduction of climate stress testing aims to evaluate whether banks possess adequate resilience to plausible climate scenarios, including both orderly and disorderly transitions to net zero emissions, with results potentially requiring additional capital or risk mitigation measures for institutions with concentrated exposures to high-emission sectors. The broader expectation that banks will contribute to financing the transition to a sustainable economy creates both opportunities for lending to green technologies and challenges associated with managing exposures to legacy, carbon-intensive industries that may face declining asset values and profitability. The evolution of payment systems toward real-time settlement, mobile payment applications, and potentially central bank digital currencies represents another domain of significant change with implications for traditional banking. The declining use of cash and checks in favor of electronic payment methods has accelerated during the COVID pandemic, as contactless payments and online commerce gained market share, with implications for bank branch viability and the economics of maintaining physical infrastructure. The Bank of England's investigation of central bank digital currency possibilities reflects both the need to ensure that public money remains accessible as private payment systems proliferate and concerns about maintaining monetary policy effectiveness in an increasingly digital economy. The potential introduction of a retail CBDC that would provide individuals with direct access to central bank money without commercial bank intermediation could substantially alter the deposit funding model that has characterized banking for centuries. Though the design choices involved in any CBDC implementation would determine the magnitude of impact on traditional banking, the enduring importance of English banking to both the domestic economy and global finance ensures that its evolution will continue to generate scholarly analysis, policy debates, and practical innovations as institutions adapt to changing technological, regulatory, and competitive environments. The remarkable transformation from medieval money lending to contemporary global financial institutions demonstrates both the adaptability of banking structures to serve evolving economic needs and the persistence of core functions, including payment services, credit intermediation, and maturity transformation, that have characterized banking across centuries. The relationship between innovation and stability that has shaped English banking development reflects tensions between the benefits of competition and change and the risks associated with experimentation in an industry where failures can generate severe social and economic costs. The regulatory frameworks that have evolved to balance these competing considerations continue to adapt as new challenges emerge, with the post-crisis reforms representing the latest chapter in an ongoing process of institutional development, rather than a definitive resolution of the fundamental questions about how banking should be organized and supervised. The post-pandemic recovery period that commenced during 2021 revealed substantial transformations in banking operational models, as institutions discovered that remote working arrangements implemented during lockdowns could be maintained permanently for significant portions of their workforce, prompting strategic reconsiderations of office space requirements and branch network configurations that had seemed immutable during previous decades. The major clearing banks announced ambitious programs to reduce their physical footprints through branch closures that accelerated trends toward digital service delivery already underway before the pandemic, with thousands of branches scheduled for closure during 2021 through 2023, as banks redirected investment toward mobile applications and online platforms that customers had adopted at unprecedented rates during lockdown periods. The branch closure programs generated criticism from consumer advocates and politicians concerned about financial exclusion of elderly customers and residents of rural areas where branch closures left entire communities without local banking access. Though banks countered that declining branch traffic and the availability of alternative service channels, including telephone banking, mobile apps, and post office banking arrangements, justified the rationalization of physical networks that had become economically unsustainable. The regulatory response to branch closures involved enhanced requirements for impact assessments and consultation with affected communities, though regulators ultimately accepted that banks possessed legitimate business reasons for reducing physical presence, provided they maintained adequate alternative service channels and considered financial inclusion implications. The recovery of bank profitability during 2021 and 2022 exceeded expectations, as loan losses from pandemic-era lending proved substantially lower than initial provisioning had anticipated, enabling banks to release credit loss reserves that had been built up during 2020 and 2021, when economic uncertainty had been greatest. The better-than-expected credit performance reflected both the effectiveness of government support programs that had sustained businesses through lockdowns and the specific characteristics of pandemic-related economic disruption that affected service industries severely, while leaving many households with enhanced savings from reduced consumption opportunities and continued employment in sectors capable of operating remotely. The major banks reported substantial profits during 2021, with return on equity metrics recovering to levels comparable to pre-pandemic performance, though this financial performance occurred against a background of continued public criticism regarding lending practices, branch closures, and executive compensation at institutions that had benefited from government support during the crisis. The government's disposal of its shareholdings in Lloyds Banking Group during 2021 through 2023, selling down its position acquired during the financial crisis, and eventually exiting ownership entirely, marked a symbolic conclusion to the state intervention of 2008, while generating debate about whether taxpayers had received adequate returns on capital injected to prevent the banking system's collapse. The inflationary pressures that emerged during 2021 and intensified through 2022 created novel challenges for banks and monetary policy, as supply chain disruptions, energy price increases, and tight labor markets combined to generate the highest inflation rates experienced in major economies since the 1980s. The Bank of England's Monetary Policy Committee responded to rising inflation through a series of interest rate increases, beginning in December 2021, that would eventually raise bank rate from its pandemic low of 0.1% to 5.25% by August 2023, representing the most aggressive tightening cycle in decades. The rapid rise in interest rates generated substantial profits for banks as the gap between deposit rates and lending rates widened, with banks proving slow to pass higher rates through to deposit customers, while quickly adjusting variable rate lending charges upward in line with policy rate increases. The asymmetric adjustment of deposit and lending rates generated political controversy and regulatory scrutiny, as consumer groups argued that banks were exploiting their market power to extract excessive profits from the inflationary environment while failing to reward savers adequately. The Competition and Markets Authority launched investigations into deposit pricing practices during 2023, examining whether insufficient competition in retail banking enabled major banks to coordinate pricing in ways that disadvantaged consumers, though the investigations ultimately concluded that while competition could be enhanced through better transparency and easier account switching, existing conduct did not constitute illegal collusion. The cryptocurrency and digital asset boom that had accelerated during 2020 and 2021 created pressures on traditional banks to develop strategies for serving clients interested in these new asset classes while managing risks associated with volatile, largely unregulated markets that had generated substantial investor losses when cryptocurrency prices collapsed during 2022. The major clearing banks generally maintained cautious approaches to cryptocurrency involvement, declining to offer direct custody or trading services for retail customers, while developing capabilities to serve institutional clients with appropriate risk management and compliance frameworks. The regulatory treatment of cryptocurrency and digital assets evolved gradually during this period, as authorities grappled with questions about whether existing financial regulations applied to these novel instruments, and whether new frameworks were required to address unique characteristics and risks. The Financial Conduct Authority's ban on the sale of cryptocurrency derivatives to retail customers, implemented in January 2021, reflected concerns that these highly leveraged products exposed unsophisticated investors to excessive risks of catastrophic losses. Though the ban did not extend to direct cryptocurrency purchases that remained available through specialized platforms operating outside traditional banking channels. The collapse of several high-profile cryptocurrency platforms, including FTX in November 2022, which resulted in billions of dollars of customer losses, vindicated regulatory caution about these markets, while intensifying demands for comprehensive regulatory frameworks that would protect consumers without stifling innovation in digital finance. The development of regulatory approaches to stablecoins and other digital payment tokens proceeded through extensive consultations during 2022 and 2023, as authorities sought to balance financial stability concerns with the potential benefits of innovation in payment systems. The Treasury's proposals for stablecoin regulation, published in 2023, established frameworks treating stablecoins used for payments similarly to traditional electronic money, with requirements for reserves backing the tokens, redemption rights for holders, and supervision by the Financial Conduct Authority. The regulatory approach aimed to enable stablecoins to integrate into the UK payment system while ensuring adequate safeguards against the risks of runs, operational failures, or fraud that could undermine confidence in these instruments or generate broader financial instability. The major banks' engagement with stablecoin regulation reflected both their concern about potential competition from technology companies entering payment services and their interest in developing their own digital token offerings that could reduce costs and enhance efficiency of wholesale payment and settlement systems. The exploration of tokenized deposits and wholesale central bank digital currency applications suggested potential transformations in interbank payment systems that could reduce settlement times, lower costs, and enable new forms of programmable money with embedded compliance features. The merger between Nationwide Building Society and Virgin Money UK, announced in December 2024, represented a significant consolidation within the UK banking sector that combined the country's largest building society with a major challenger bank, creating an institution with substantial scale in mortgage lending and retail deposits. The transaction, valued at approximately £3 billion, reflected both Nationwide's ambition to expand beyond its traditional building society model and Virgin Money's shareholders' desire to realize value from an institution that had struggled to generate consistent profitability as an independent entity. The regulatory approval process for the merger involved detailed examination of competition impacts in local markets, where both institutions had significant presence, with particular attention to mortgage lending and savings products, where market concentration already raised concerns about limited consumer choice. The Financial Conduct Authority's conditional approval of the merger, granted in March 2025, included requirements for maintaining specific product offerings and service standards to protect existing customers during integration, while requiring enhanced monitoring of pricing behavior to ensure the combined entity did not exploit reduced competition. The merger exemplified ongoing consolidation pressures in UK banking as institutions sought scale to spread technology investments and regulatory compliance costs across larger customer bases, while generating efficiency gains through elimination of duplicate infrastructure. The artificial intelligence revolution that accelerated dramatically during 2023 and 2024 created both enormous opportunities and substantial risks for banking institutions as generative AI capabilities enabled automation of customer service, credit assessment, fraud detection, and various other functions previously requiring human judgment. The major banks invested heavily in AI capabilities during this period, developing chatbots and virtual assistants capable of handling routine customer inquiries without human intervention, while deploying machine learning models to detect fraudulent transactions with greater accuracy than traditional rule-based systems. The application of AI to credit underwriting raised concerns about algorithmic bias and discrimination, as models trained on historical data might perpetuate or amplify existing patterns of unequal treatment based on protected characteristics including race, gender, or geographic location. The regulatory response to AI in banking emphasized principles of explainability, fairness, and human oversight, requiring that institutions using AI for material decisions maintain capability to explain how algorithms reach specific conclusions and demonstrate that models did not produce discriminatory outcomes when tested against diverse populations. The Prudential Regulation Authority's supervisory expectations regarding AI governance, published in 2024, established requirements for board-level oversight of AI strategy, robust testing and validation of models before deployment, and ongoing monitoring of AI system performance to detect drift or unexpected behaviors that could generate risks. The Operational Resilience Framework that became effective in March 2022 created comprehensive requirements for banks to identify important business services essential to the functioning of the financial system, establish impact tolerances, specifying maximum acceptable disruption durations, and test their ability to remain within these tolerances under severe but plausible scenarios, including cyber attacks, technology failures, and loss of key facilities or personnel. The framework represented a shift from traditional business continuity planning, focused on maintaining operations at specific locations, toward a more holistic approach, examining end-to-end service delivery and dependencies on third parties, including cloud service providers, payment system operators, and other critical service providers whose failures could disrupt bank operations. The implementation of operational resilience requirements revealed substantial dependencies on small numbers of technology providers, particularly for cloud computing and specialized software applications, raising concerns about concentration risk and the potential for single points of failure that could impact multiple institutions simultaneously. The regulator's response included enhanced oversight of critical third-party providers and requirements that banks maintain ability to switch providers or bring services in-house if essential suppliers became unavailable, unreliable, though the practical implementation of such contingency arrangements proved challenging, given the technical complexity and substantial costs involved in maintaining true alternative capabilities. The evolution of bank capital requirements during the early 2020s involved implementation of the finalized Basel III reforms, often called Basel 3.1 or the Basel III Endgame, which revised the calculation of risk-weighted assets for various exposure categories and introduced requirements for output floors, limiting the degree to which internal models could reduce capital requirements below standardized approaches. The UK's implementation of these standards through proposals published by the Prudential Regulation Authority in 2023 involved substantial increases in capital requirements for certain mortgage and corporate exposures, with major banks required to hold additional capital, totaling several tens of billions of pounds collectively, once the rules became fully effective. The banking industry's response to these proposals emphasized concerns about competitive impacts relative to other jurisdictions that might implement standards differently, potential constraints on lending that could harm economic growth, and questions about whether the substantial capital increases were necessary given the strong resilience already demonstrated during the COVID crisis. The PRA's final rules, published in mid-2024, maintained most of the proposed increases, while providing extended transition periods and some modifications to specific requirements in response to industry feedback, reflecting the regulator's judgment that enhanced capital provided valuable additional resilience despite the costs and competitive concerns raised by banks. The Consumer Duty regulation that took effect in July 2023 established far-reaching requirements for banks and other financial services firms to act to deliver good outcomes for retail customers, representing a fundamental shift in regulatory approach from rules-based compliance toward outcome-focused supervision, emphasizing the substantive quality of customer treatment. The regulation required firms to consider whether their products and services provided fair value, ensure communications were clear and not misleading, provide appropriate customer support throughout the customer relationship, and design products with characteristics meeting the needs of target customer groups. The Consumer Duty's broad principles created substantial implementation challenges as banks worked to assess whether existing products and practices met the new standards, while developing systems to monitor outcomes and identify potential breaches requiring remediation. The enhanced obligations regarding fair value and good customer outcomes generated particular concern in areas including overdraft pricing, complex structured products, and situations where customers held products no longer suitable for their circumstances but had not actively switched to more appropriate alternatives. The Financial Conduct Authority's supervision of Consumer Duty implementation emphasized the need for cultural change within banks beyond mere compliance with specific rules, requiring senior management to demonstrate active engagement with customer outcome monitoring and evidence of willingness to modify practices when analysis revealed poor outcomes. The climate-related disclosure requirements that became mandatory for major banks during 2022 and 2023 represented the initial phase of a broader regulatory agenda aimed at ensuring that climate risks were appropriately incorporated into financial decision-making and that markets possessed adequate information to assess institutions' exposure to these risks. The disclosures required under the Task Force on Climate-Related Financial Disclosures framework included governance arrangements for managing climate risks, strategy for addressing climate-related risks and opportunities, risk management processes for identifying and managing climate exposures, and metrics including financed emissions across loan portfolios. The preparation of initial disclosures revealed substantial data gaps and methodological challenges in calculating financed emissions, with banks dependent on borrowers' disclosure of their own emissions and forced to use industry averages or estimation methodologies when client-specific data proved unavailable. The disclosed financed emissions figures demonstrated that major UK banks' loan portfolios were associated with hundreds of millions of tons of carbon dioxide equivalent annually, with particular concentrations in carbon-intensive sectors, including oil and gas, power generation, heavy industry, and commercial real estate. The regulatory expectations that banks would develop transition plans showing how their portfolios would evolve toward alignment with net zero emissions by 2050 created strategic challenges as institutions balance climate commitments with obligations to serve clients across all sectors, including those likely to face declining demand or stranded assets as the economy decarbonizes. The emergence of embedded finance as a significant trend in financial services delivery involved non-bank companies integrating banking services directly into their platforms and customer journeys, enabling consumers to access credit, payments, and insurance without visiting traditional bank interfaces. The partnerships between technology platforms and licensed banks that enabled embedded finance typically involved the platform handling customer acquisition and interface, while the bank provided regulatory authorization and balance sheet capacity for lending or deposit taking. The growth of embedded finance in areas including point-of-sale lending, business banking, integrated into accounting software, and payment services embedded in e-commerce platforms created competitive pressures on traditional banks while raising regulatory questions about responsibility for consumer protection when services were delivered through complex partnership arrangements. The regulatory principle of same risk, same regulation suggested that embedded finance arrangements should face requirements comparable to those applied to traditional banking channels, though the practical implementation of supervision across fragmented partnership structures proved challenging. The Financial Conduct Authority's guidance on responsibilities in embedded finance arrangements, issued in 2024, emphasized that both the regulated bank and the platform partner bore obligations for ensuring appropriate customer treatment, with the bank unable to delegate its regulatory responsibilities even when a partner controlled customer interactions. The pension system's evolution during the early 2020s created significant implications for banks' wealth management and retirement services businesses, as the shift from defined benefit to defined contribution pension arrangements placed increasing responsibility on individuals for investment decisions and retirement planning. The introduction of pension dashboards, enabling individuals to view all their pension pots in a single digital interface, aimed to address the problem of lost pensions and encourage more active engagement with retirement savings, though implementation proved technically complex and repeatedly delayed beyond initial target dates. The major banks' strategies in retirement services emphasized comprehensive advice and investment management, targeting the substantial cohort of baby boomers reaching retirement with significant accumulated pension wealth and facing complex decisions about drawdown strategies, annuity purchases, and intergenerational wealth transfer. The regulatory framework governing pension advice underwent continued development during this period, as authorities sought to ensure that individuals received appropriate guidance when making irreversible decisions with profound implications for retirement security, with particular attention to transfers from defined benefit schemes, where advice became mandatory following scandals involving inappropriate transfer recommendations during previous years. The fraud epidemic that intensified during and after the COVID pandemic, with criminals exploiting digital channels and social engineering techniques to steal billions of pounds annually from bank customers, generated enormous pressure on institutions to enhance fraud prevention systems while raising difficult questions about responsibility for losses when customers authorized payments to fraudsters. The authorized push payment fraud phenomenon, in which victims were deceived into authorizing transfers to accounts controlled by criminals, proved particularly challenging to address because existing payment systems prioritize speed and convenience over verification that payment recipients were legitimate and intended counterparties. The voluntary reimbursement code established by the payments industry in 2019 proved inadequate to address the scale of fraud losses, with many victims denied reimbursement on grounds that they had failed to take sufficient care or ignore warnings, despite the sophisticated nature of criminal tactics. The mandatory reimbursement requirement that took effect in October 2024 established that payment service providers must reimburse victims of authorized push payment fraud, except in cases of gross negligence or criminal complicity, fundamentally shifting liability and creating strong incentives for banks to invest in fraud prevention technologies and customer education. The implementation of the reimbursement requirement generated disputes about the definition of gross negligence and appropriate allocation of costs between sending and receiving payment providers, with ongoing regulatory guidance needed to address edge cases and ensure consistent application across institutions. The economic uncertainty that characterized 2022 through 2024, driven by factors including energy, price volatility, geopolitical tensions from Russia's invasion of Ukraine, supply chain disruptions, and the most rapid interest rate increases in decades, created substantial challenges for banks managing credit risk and supporting customers through difficult economic conditions. The commercial real estate sector experienced particular stress as rising interest rates coincided with structural changes in office utilization following pandemic-driven shifts toward remote work, creating concerns about property valuations and the ability of borrowers with maturing mortgages to refinance at substantially higher rates. The bank's forbearance approaches to troubled commercial real estate borrowers emphasized extending maturity dates and accepting temporary interest concessions, rather than forcing property sales into distressed markets that might crystallize large losses. Though this strategy required convincing regulators that forbearance reflected realistic prospects for recovery, rather than delay tactics aimed at avoiding recognition of impaired loans. The residential mortgage market faced pressures from rising rates that increased monthly payments for variable-rate borrowers and created affordability challenges for customers, with fixed-rate mortgages approaching maturity, facing refinancing at rates several percentage points higher than their existing mortgages. The support measures that banks implemented for troubled mortgage borrowers included payment holidays, term extensions, and temporary conversions to interest-only payments. Interventions aimed at helping customers adjust to higher rates while avoiding possessions that would harm both borrowers and lenders. The strategic repositioning of major banks during the early 2020s reflected assessments of competitive advantages, regulatory environments, and growth opportunities in different geographic markets and business lines, with several institutions making significant decisions to exit certain activities or jurisdictions while doubling down on areas considered core strengths. HSBC's decision, announced in 2023 to pursue a restructuring that would substantially reduce its presence in retail banking outside Asia, reflected the institution's judgment that its complex global structure generated excessive costs and regulatory complexity relative to the returns achievable in markets where it lacked scale or deep market positions. The bank's strategy of focusing resources on wealth management and commercial banking in Asia, while maintaining investment banking and commercial banking capabilities in the UK, represented a recognition that universal banking models, spanning multiple geographies and business lines, had become difficult to manage effectively in an environment of heightened regulatory requirements, increased capital demands, and pressure from investors for strategic clarity. NatWest Group's accelerated wind-down of its Irish operations and the sale of various non-core businesses reflected similar pressures to simplify operations and focus capital on markets where the institution possessed genuine competitive advantages, with management emphasizing that geographic diversification generated limited benefits in retail banking, where local market knowledge and presence determined success. The technology infrastructure transformation that major banks undertook during the early 2020s involved substantial multi-year programs aimed at replacing legacy systems built on outdated mainframe technology, with modern, cloud-based architectures enabling greater agility, lower costs, and enhanced customer experiences. The complexity of these transformation programs reflected both the technical challenges of migrating critical systems, handling millions of daily transactions, and the organizational challenges of executing major change programs while maintaining business-as-usual operations that customers and regulators expected to continue without disruption. The major banks collectively invested tens of billions of pounds in technology modernization during this period, with programs typically requiring 5 to 10 years for complete implementation and generating substantial interim costs before efficiency benefits could be fully realized. The cloud migration strategies pursued by banks typically involved hybrid approaches, utilizing both public cloud services from providers, including Amazon Web Services, Microsoft Azure, and Google Cloud Platform, alongside private cloud infrastructure for particularly sensitive data or applications where regulatory requirements or risk considerations supported continued internal hosting. The regulatory expectations around cloud adoption emphasized the need for rigorous due diligence of cloud providers, contractual protections, ensuring banks could access data and maintain operations if provider relationships terminated, and comprehensive testing of resilience, including ability to switch between providers or restore services from backup systems. The The small business lending market experienced significant disruption during the early 2020s, as challenger banks and fintech lenders deployed automated underwriting and streamlined application processes that enabled faster credit decisions than traditional banks typically provided, forcing incumbent institutions to modernize their own small business lending operations to remain competitive. The digitization of small business lending involved replacement of manual underwriting processes, requiring extensive documentation and in-person meetings, with automated workflows that could extract financial information from accounting software, analyze bank transaction data, and generate credit decisions within hours rather than weeks. The enhanced ability to assess creditworthiness using alternative data sources including payment patterns, online reviews, and supply chain information enabled lenders to serve smaller businesses and those lacking traditional credit histories while maintaining acceptable risk-adjusted returns. The regulatory treatment of automated lending emphasized the need for appropriate model governance, testing for discriminatory outcomes, and maintenance of human oversight for marginal decisions where algorithmic recommendations might benefit from qualitative judgment that models could not capture. The Competition and Markets Authority's interventions in small business banking, including requirements for large banks to share transaction data with alternative providers through open banking interfaces, aim to reduce incumbent advantages and enable competition based on service quality and pricing, rather than mere customer inertia and switching costs. The wealth management sector witnessed substantial growth during the early 2020s as accumulated assets from decades of economic growth, house price appreciation, and pension saving created an expanding population of high net worth individuals, requiring sophisticated advice and investment solutions beyond what mass market retail banking services could provide. The major clearing bank strategies in wealth management emphasize both organic growth through development of advisory capabilities and selective acquisitions of established wealth management firms with strong client relationships and investment performance records. The blurring of traditional boundaries between private banking serving ultra-high net worth clients and mass affluent services, targeting customers with more modest but still substantial wealth, reflected institutions' recognition that profitability in retail banking increasingly concentrated in more complex, advice-intensive relationships rather than transactional banking services, where margins had compressed toward commodity levels. The regulatory framework governing wealth management evolved to emphasize suitability of advice, management of conflicts of interest, and transparency of costs and charges, with particular scrutiny of vertically integrated models, where banks distributed their own investment products through affiliated advisors who might face incentives to favor proprietary products over better alternatives available from competitors. The buy now pay later phenomenon that exploded during 2020 and 2021 created a new category of consumer credit that operated largely outside traditional regulatory frameworks, enabling technology companies to offer interest-free installment plans for retail purchases without the consumer protections and affordability requirements applicable to credit cards or personal loans. The rapid growth of BNPL providers, including Klarna, ClearPay, and Affirm, generated concerns about consumer detriment, as the ease of obtaining credit might encourage overspending, while the exemption from credit reporting meant that individuals could accumulate multiple BNPL obligations without these commitments appearing on credit files visible to other lenders assessing affordability. The regulatory response to BNPL evolved during 2023 and 2024, as the government consulted on bringing these products within the consumer credit regulatory framework, ultimately deciding to require BNPL providers to conduct affordability assessments, provide clear information about repayment obligations, and report to credit reference agencies. The established banks' response to BNPL competition included development of their own installment products and partnerships with retailers to offer point-of-sale finance, leveraging their existing customer relationships and access to comprehensive financial information, enabling more sophisticated affordability assessment than purely transactional BNPL providers could achieve. The evolution of sanctions enforcement following Russia's invasion of Ukraine in February 2022 created enormous compliance challenges for banks as Western governments imposed unprecedented restrictions on transactions involving Russian individuals, entities, and financial institutions. The speed with which sanctions were imposed and modified required banks to develop enhanced monitoring capabilities and maintain flexibility to implement new restrictions, often announced with limited notice and requiring immediate effect. The humanitarian exceptions embedded in many sanctions regimes, permitting transactions related to food, medicine, and other essential goods, despite general prohibitions on dealing with sanctioned parties, created interpretation challenges as banks sought to balance compliance with sanctions against obligations to enable legitimate humanitarian activities. The substantial investments in sanctions compliance infrastructure that banks made during this period included enhanced transaction monitoring systems, specialized staff with expertise in sanctions regulations, and legal capabilities to interpret complex and sometimes ambiguous restrictions. The extraterritorial application of sanctions regimes created particular complexity as banks operating across multiple jurisdictions needed to comply with potentially conflicting requirements from different governments, with US sanctions often applying globally to dollar-denominated transactions, regardless of the location of the parties or underlying activity. The insurance distribution activities that banks had developed over previous decades came under enhanced regulatory scrutiny during the early 2020s, following historical mis-selling scandals and concerns that vertically integrated models created conflicts between banks' interests in generating distribution revenues and customers' interests in obtaining suitable products at fair prices. The reforms to insurance distribution regulation, implemented in 2022, enhanced requirements for banks to assess insurance product value, ensure target market definitions matched actual customer populations, and maintain surveillance of product performance to identify poor outcomes requiring remediation. The substantially increased focus on value assessment required banks to justify pricing across insurance product ranges, demonstrating that premiums bore reasonable relationships to expected claims and that products provided benefits commensurate with their costs. The travel insurance and mobile phone insurance products that banks commonly offered alongside current accounts faced particular scrutiny, as analysis revealed that many customers purchased coverage they did not need or could obtain more cheaply through alternative channels, while claims acceptance rates and average payouts suggested that premiums substantially exceeded the value delivered to policyholders collectively. The cross-border payments modernization agenda that gained momentum during the early 2020s reflected growing frustration with the cost, speed, and transparency of international money transfers that relied on correspondent banking networks and messaging systems developed during previous decades. The SWIFT messaging system that had connected banks globally since the 1970s faced criticism for its batch processing approach that introduced delays and its lack of transparency regarding fees and exchange rates applied by multiple intermediaries involved in routing payments between originating and destination banks. The development of ISO 20022, a new messaging standard supporting richer payment data and enabling faster processing than the older formats SWIFT had employed historically, represented an important technical upgrade, though implementation across thousands of financial institutions globally proceeded gradually through the early 20s. The Bank of England's exploration of wholesale central bank digital currency applications focused substantially on enabling faster and cheaper cross-border payments through direct connections between central bank settlement systems, potentially bypassing correspondent banking arrangements that added cost and complexity to international transfers. The emergence of stablecoin payment networks and cryptocurrency rails as alternative mechanisms for cross-border value transfer created competitive pressure on traditional banking channels while raising regulatory concerns about financial stability, money laundering risks, and the implications of private payment systems operating outside central bank oversight. The geopolitical fragmentation that intensified during the early 2020s, driven by tensions between Western democracies and authoritarian regimes in China and Russia, created substantial challenges for banks with significant international operations as governments imposed restrictions on technology transfer, investment flows, and business relationships with entities in rival blocs. The weaponization of financial systems through sanctions and the threat of exclusion from dollar clearing systems generated efforts by China and other countries to develop alternative payment arrangements and reduce dependence on Western-controlled financial infrastructure. The internationalization of the Chinese renminbi proceeded gradually during this period through the establishment of clearing arrangements, currency swap lines, and requirements that trading partners in Belt and Road Initiative countries accept renminbi for certain transactions, though the currency's role in global trade and finance remained modest relative to China's share of world economic output. The major UK bank strategies for managing geopolitical tensions emphasized maintaining compliance with Western sanctions and export controls, while preserving access to Asian markets through carefully structured operations that separated activities in different jurisdictions and avoided business lines most likely to trigger regulatory concerns. The potential for financial system fragmentation into competing currency and payment blocks created uncertainty about the future of the globally integrated financial architecture that had developed during the post-war period, with implications for the role of London as an international financial centre if cross-border banking became increasingly constrained by political considerations. The resolution framework for failing banks that had been established following the financial crisis underwent continued refinement during the early 2020s as regulators sought to ensure that resolution powers could be deployed effectively without generating broader financial instability or requiring taxpayer support. The minimum requirement for own funds and eligible liabilities, known as MREL, specified levels of capital and debt that banks must maintain to ensure adequate loss-absorbing capacity for resolution scenarios, with major banks required to hold MREL totaling between 25 and 35% of risk-weighted assets, depending on their systemic importance and business models. The development of detailed resolution plans for major institutions involved extensive work by banks and regulators to identify critical functions that must continue operating through resolution, assess operational and financial dependencies that could complicate resolution, execution, and ensure that legal entity structures enabled resolution authorities to impose losses on shareholders and creditors without disrupting essential services. The testing of operational capabilities for resolution scenarios, including the rapid establishment of bridge banks to maintain critical functions, the bail-in of debt holders to absorb losses and recapitalize failing institutions, and the transfer of assets and liabilities to acquiring institutions demonstrated both progress in resolution preparedness and remaining challenges in areas including derivatives, portfolios, cross-border coordination, and maintaining market confidence during resolution execution. The cybersecurity threats facing banks intensified continuously during the early 2020s as criminal groups and state-sponsored actors developed increasingly sophisticated attack capabilities, while the expanding digital attack surface created by cloud adoption, remote working, and proliferating third-party connections generated additional vulnerabilities. The frequency and severity of ransomware attacks increased substantially during this period, with criminals encrypting bank data and demanding payment for decryption keys while threatening to publish stolen information if ransoms were not paid. The regulatory response to escalating cyber threats included enhanced requirements for banks to maintain comprehensive security controls, conduct regular penetration testing and vulnerability assessments, implement robust incident response procedures, and maintain ability to restore critical systems from backups following successful attacks. The intelligence sharing arrangements between banks, government security agencies, and specialized threat intelligence providers aim to enable more rapid detection and response to emerging threats by disseminating information about attack techniques, indicators of compromise, and adversary tactics across the financial sector. The significant investments in cybersecurity that banks made during this period included advanced monitoring and detection systems, utilizing AI to identify anomalous behavior, enhanced authentication mechanisms, including multi-factor authentication and biometric verification, and expansion of security operations centers, staffed by specialized personnel, monitoring for threats continuously. The diversity and inclusion initiatives that gained prominence in banking during the early 2020s reflected both societal pressures for greater representation of women and ethnic minorities in leadership positions and growing evidence that diverse teams generated better business outcomes through broader perspectives and reduced groupthink. The major banks published diversity statistics and established targets for representation at various organizational levels, with particular focus on increasing gender and ethnic diversity among senior management and board members, where historical patterns showed substantial underrepresentation relative to workforce demographics. The regulatory expectations regarding diversity evolved during this period from general principles about governance effectiveness to more specific requirements for diversity policies, monitoring of progress, and explanations when institutions failed to meet targets or industry benchmarks. The enhanced scrutiny of pay gaps between demographic groups revealed persistent disparities that banks committed to addressing through reviews of promotion processes, compensation practices, and talent development programs. Though critics argued that progress remained inadequate and that commitments to diversity sometimes amounted to performative gestures rather than fundamental cultural change. The business case for diversity emphasized research findings that diverse teams made better decisions, identified risks more effectively, and better understood diverse customer bases, though translating these general principles into specific actions that would meaningfully change organizational demographics and culture proved challenging for institutions shaped by decades of relatively homogeneous leadership. The regulatory stress that emerged during 2023 and 2024 as US regional bank failures, Swiss Credit Suisse's collapse, and various other international banking disturbances reminded markets that financial stability remained fragile, despite post-crisis reforms generated fresh debates about optimal capital requirements, resolution frameworks, and supervisory approaches. The failure of Silicon Valley Bank in March 2023, resulting from concentrated exposure to technology sector deposits, inadequate management of interest rate risk, and supervisory failures to address known problems before they became critical, demonstrated that seemingly well-capitalized banks could collapse rapidly when deposit runs accelerated through digital channels. The UK banking system's resilience during this period of international stress reflected both the stronger capital positions and more conservative risk management that UK institutions had maintained following the financial crisis. The more intensive supervision that the Prudential Regulation Authority conducted compared to some other jurisdictions. The rapid resolution of Credit Suisse through forced merger with UBS demonstrated both the potential effectiveness of resolution frameworks and the challenges of managing systemically important bank failures without generating broader financial instability, with questions remaining about whether the Swiss approach represented a model for other jurisdictions or reflected unique circumstances unlikely to be replicable elsewhere.